Well, a Friday surge helped the bulls end the week on a high. The Nifty and the Sensex gained for the 8th straight week, the longest winning streak in 7 years. On the Editors Roundtable, we take a look at EPS upgrades and downgrades. We also decode why insurance companies are making a comeback. I'm Sonia, and with me are the editors Prashant, Nigel, Nimesh. Also joining us in our new studio is Rahul Arora, CEO of Nirmal Equities. Guys, thanks for joining us on the show. Well, I don't think anyone would have expected this kind of a recovery in the market, right? After what came out in the budget. And I mean, at a time when LTCG, STCG was hiked, the market recovered big time.
I mean, we're being surprised every day, Sonia, right? Yeah. As you said, it's essentially the election result. There was a bit of a shocker, the budget, the tax hike. And actually, by the end of the week, if someone really blanked out all news and looked at just what markets did, I think they would be forgiven to imagine that actually taxes went down, did not go up. So it's been a super strong market and really Teflon coated in that sense, right?
In fact,
I think it's also because of the positioning, Prashant. We spoke about it last week, right? The amount of cash domestic mutual funds are sitting on. Add to that, in fact, the cash levels have only gone up in the last many days across many of the aggressive funds. So that was the PMSs are sitting on cash. We spoke about large HN investors this week, and they all were like, little cautious and a bit careful and watchful in the market, right? So there's so much of, caution in the market right now that market can't fall when there is so much of pessimism in the market. So I guess that's what is playing out. Too much of pessimism, and now, it's a chase to redeploy that money, so to speak, and that's the reason why we saw a big reaction today. 400 point on the Nifty.
When they tinkered with the tax rate, you had the ghost of 2008, 18 that came back, right? Because that day the market didn't fall. Next few days it fell down. Next 40 days it was down 10%. And the broader markets got clobbered. This time around, the broader markets actually have done pretty okay, in the last few sessions. So that's heartening to see because portfolios will be feeling much better.
Absolutely. So, in case you missed out on what happened in the week, right? I mean, it was a really long week given that we had the budget in the middle of the week. But at the end of the week, there was a big recovery in the market. In fact, the Nifty was up over 400 points on Friday. The Nifty is back at record highs now, and there was large buying by domestic institutions as well in the last few days. So if you look at it, as Nimesh was also pointing out, the cash deployment from domestic mutual funds began after the budget and post the announcements that came through. If you look at individual stocks as well, right, many stocks by the end of the week hit fresh highs, whether it was Tata Motors, TCS, Infosys, Ashok Leyland in the broader markets. All these stocks hit fresh highs this week. So very interesting week. Rahul Arora of Nirmal is with us. Rahul, interesting week, but what has your big takeaway been from the budget and there were no repercussions in the market, so to speak, but the impact on the market going forward?
So I think the budget, by and large, barring the tinkering on the capital gains tax, was exactly the way it should have been. There was a thrust towards reviving the bottom of the pyramid. It may not have been very overt in nature, but the kind of outlays, like 3 lakh crores for women, 2.5 lakh crores for infra in terms of jobs, announcing internships, agreeing to pay 15,000 of salary for the formal sector. It was a lot about employment and sort of the bottom of the pyramid. I think obviously there was some political compulsion. So you saw the announcements for Bihar and Andhra Pradesh. I think that was expected before we went in, but nothing to alter the course of the markets. And I think, as Prashant was saying when you guys started the show, I think even if you go back to the day the election results were announced, the lowest point of the day that day was minus 2,000 for the Nifty, and it closed only minus 1,300. So you had a 700-point pullback from the day's low. You saw something similar a few days back, but I'm a bit in a state of shock as to what's happening because I remember being on Bazaar after the state elections, and I think the Nifty then was about 19,000, and I think we were discussing what could happen over the next 5 years if Modi came back, and I had said there's no reason that the market can't double. So we were talking about a 37,000 Nifty, and you've already traversed so much ground. You're at 25. You start wondering what could potentially be. But I think the point Nimesh was making is see, the Nifty has tripled in 4 years. From 8,000, it's gone to 25,000, right? And the size of the mutual fund industry, which was 5 lakh crores at Demon, today is 60 lakh crores. Right. Of that, even if you assume half is equities, which is 30 lakh crores, And even if you assume 3% on average cash of mutual funds, you're talking about 90,000 crores cash in the system just with mutual funds. Add insurance, AIF, PMS, family offices, that number could be anywhere close to 1.5 lakh, 2 lakh crores. So I think gone are the days where you saw material 20-30% corrections in stocks. I think today, because fund managers, CTCs are also locked in to their own funds, the pressure on performance is that much more, and you're watching quarterly movements that much more. So I think to that extent, any fall that you're getting, and I think the reason, Sonia, is if you analyze the top 3 funds in India today, ICICI, SBI and HDFC, you'll be shocked to see the number of stocks that they're owning 10% off. I mean, the money that's chasing the same names, and it's not made in small caps, it is large, it is banks. You know, and in some cases where they can't buy them directly, they're tying up with their insurance arm and taking RBI approval to buy them. That is what liquidity is. So I think there's no point standing against it. But I must say that we need to temper our expectations. A 3x return in the Nifty in 4 years, this cannot continue. I would be extremely shocked. I still wouldn't be surprised if we hit a 35-40,000 Nifty, in the next 5 years, but that would probably mean a 13-14% kind of CAGR. So if you have those kind of expectations, in which you will have down years, you may have a year where your Nifty is down 20-25% and then rebounds 35-40%. But I think in aggregate, if you look at the next 5 years, you should probably be expecting a 13 to 15% kind of CAGR in the markets, which would probably be what earnings would also give you.
You know, Prashant, as what Rahul also said, I think this market is slave of earnings, right? And you've worked on a piece on one. I mean, at least ultimately it pays off, right? That earning has to catch up. In fact, you know what Rahul said, that Nifty has tripled. Even if you look at the broader markets or for the large cap, large universe, the revenues have tripled and the profits have doubled as well. So, you know, market has, the earnings has caught up as well with most of the companies across broader markets and mid caps as well. So, ultimately, you know, it's the earnings which is going to support this kind of valuations, right? So, I guess you've put some piece, right?
Rahul, right? I mean, when you talk about longer term projections, I heard 2 things. That's just interesting. Chris Wood was in our studios, and he was saying, Ramesh Damaniji asked that question to him. He said, you know, what can happen? How large can bull markets be? His answer was, look at what happened in the 70s in the US with 401ks. And that was a big bull market. Lately, I mean, I think after the budget, I heard someone talk about the Japanese experience, where you had the Nikkei going up. So people are now starting to, I mean, you know, it's kind of going back in history, because you don't have, you're at all-time highs, and the markets have done precedent, right? So you kind of, I'm not sure how relevant many of these are, but you're being forced to do that because the market continues to run higher.
No, but I think, Prashant, you have to balance that with price to earnings multiples. I think if you look at most of the multinational companies listed in India, if you see their parents, wherever they're trading at half the multiples. The best stock in the world for the last 18 months, which is Nvidia, you'd be surprised trades at less than 30 times. So, you know, if you're going to compound your earnings, so I think bull markets can last if valuations are reasonable. And I'll just give you a point. If you look at HDFC Mutual Fund, they recently raised a manufacturing and defense fund. See, caution has come into the market. Just take a look at that fact sheet. Only 55% of what they have raised in that 9,500 crores has been deployed. They're sitting on 45% cash in a 9,500 crore fund. I mean, the size of that fund is larger than a lot of mutual funds in India. But I think there is caution that's coming into the market. But I think you've got to base it to valuations. I don't think anything in the US, even at the peak of, the Netflix and the Amazons and the Googles, I don't think anything was trading at, say, the defense companies' valuations in India. So these bull markets can sustain if valuations are reasonable. But when you are,
Nimesh gave a nice example.
Hitachi is trading at 300 times in India, whereas the parent is quoting at, on a forward earnings, is quoting at 22 times. So.
Exactly. So I think, we saw that. I mean, I remember when we were, in another avatar when I was working with the promoter of UTV, and we were looking at Disney's valuations and the way they came in. So I think India is just a very distorted market when it comes to valuations. But I think when you balance the scales, bull markets can be sustained very long if valuations are reasonable. But you should exercise caution.
The 2004 bull market started with Nifty at 12 times earnings.
Absolutely.
So, anyway, I'll talk about earnings, which no one wants to hear about. Trust me, no one really wants to talk about earnings in that sense, because, people are just busy, looking up, right? Looking up in terms of how high and how fast stocks are running. And of course, earnings come and go. Perhaps too early to call it a full report card, because it's not a full accounting of things. As you said, what we're basically trying to do is looking at how earnings expectations for FY25 have changed in the last 1 month for companies out of the NSE 200 list. And these are the top tracked, well-owned companies, liquid, large, mid companies. And you know, how many have seen upgrades to their full year estimates and how many have seen downgrades? So the reason I say it's not a full accounting, if it's not even half the accounting, is because only 70 have reported out of NSE 200 as of yesterday's close. But out of the 70 which have reported, I mean, I think the numbers are pretty, stark. 40 have seen EPS being downgraded. Only 18 have seen EPS numbers being upgraded. And mind you, out of these 18 companies also, you got lots of, I mean, about 4 or 5 of them where the upgrades are about 1%, 1.5%, small upgrades. So I'm counting for that as well. So this is essentially the list of companies which have seen the largest downgrades. I'm not putting out all of them, but Bank of Maharashtra, Paytm, which of course was a big mover, but for other reasons, JSW has seen full year 25 earnings being taken down 12%. There is Loris, you know, a lot of tech companies, right? Coforge, Tata Elxsi, Tata Technologies have seen these downgrades. Tata Communication is another one which is down about earnings around 6%, marked down by the street. These are all from sort of Bloomberg consensus estimates. Asian Paints, Dalmia Bharat, and SRF as well. As I said, total of 40, but the top ones there. Now, which are the companies which have seen upgrades? You'll find a lot of insurance companies here. So look at this: ICICI Pru, there is ICICI Lombard, SBI Life, HDFC Life. This is the cohort which has seen the maximum upgrades. There is asset management company, HDFC AMC as well, which has seen about a 8% upgrade. Others, there is Suzlon, Kotak Bank, Canara Bank, and a BPCL out there. So 18 here, but of course I've not put all of them, but the top upgrades which are really coming through. I mean, markets continue to do very well, and I hope that as the earnings season proceeds and we get to the 50% mark, and then of course beyond that, you get more positive surprises because, at the end of the day, stocks, at least in the medium to long term, will return what earnings return. So you need earnings growth to pick up substantially, at least till now, from what we've seen, that has not been happening. Rahul, any thoughts at all?
I think insurance is the interesting piece here, Prashant, and I think a lot of this has to do with both annuity as well as ULIPs. I think if you look at the ULIPs for ICICI Pru, SBI Life, they've grown dramatically. I think if I'm not mistaken, there was a 70% growth in ULIP for ICICI Pru, and annuity grew by almost 125%. Now, what this also does is this skews the VNB margin, because when you're skewed more towards protection, your VNB margins go higher. But I think they'll probably correct themselves. But interestingly, ICICI Pru, which was the stepson of the market for a long time, is now trading on par with SBI Life. Your point about overall earnings, I think we're still in an earnings downgrade cycle. I think if I look at trailing 4 quarters, even at our brokerage, I think it'll be 60-40 in favor of downgrade. So you're not technically in an earnings upgrade cycle, but yeah, insurance is one pocket of the market that has surprised positively, as is Alcobev. I think, we saw that with United Breweries, and I think even from the oil and gas space, something that doesn't get discussed often, I think Petronet LNG stood out for us, in a very material way. But apart from that, I think from the earnings that sort of have gone by, I think United Spirits, Insurance, Petronet LNG sort of come out. And of course, when the earnings season started, you had, TCS, Infi were not as bad, and we saw the reactions. But I think on balance, it's been a bit mixed with some of these standing up.
Okay, let's do one thing. Let's take a quick commercial break. When we come back, we'll get talking about more of the market trends and all the cues that you need to watch out for next week. Do stay tuned in.
Welcome back. You're tuned in to Editor's Roundtable. Well, let's focus on the insurance space. And it appears that the bulls, well, they are back interested in the insurance companies, or at least they're looking to get insured, it seems so. Because in the last 1 month or so, if you look at it, well, the Nifty is up close to 4%, but these insurance companies that actually underperformed, they have come back into play. And in the past week, they're up anything between 10 to around 15%. What went so right? Well, let's put up a few factors out there. There was no adverse regulation that came in the budget. One of the fears was that maybe, in fact, the taxation that they pay, that could be moved up a little bit. That didn't happen. The second factor was, in the last budget, we saw that traditional products, where the premium was more than 5 lakhs, it came under the tax net. Well, the fear was that even those below 5 lakhs premium, that as well could get caught up. So that didn't happen as well. And the third factor was, currently, if your ULIP premium is less than 2.5 lakh, well, it doesn't attract tax. The fear was that as well could have been brought under the net. And all those three didn't take place, so the street was happy. The other factor was that the impact of the surrender value. people were fearing that this could have an impact. Back of an envelope calculation told you that it won't have more than 1.5% to 2%. But nonetheless, that was a bit of an overhang on some of these companies. But the managements have indicated that they are trying various ways to wriggle out of this. And few factors that they have been talking about is that the agent's commission, well, instead of it being paid all upfront, it could be delayed. It could be paid in a bit of a staggered manner. And also they're looking to squeeze in maybe a clawback clause. So that's what could help them as well and mitigate the fall of the surrender value out there. The industry basically is coming together, and it appears they're looking to bargain with the agent's commission. The third factor is, if you look at the results, they're fairly good. Whether you look at the APA or the VNB, they were fairly good in the past quarter itself, though margins, the VNB margins did come in for some pressure. But now the street is calling for bottoming out of the VNB margins. How is that? ULIP as a percentage of the total mix, that had gone up drastically. Now the indications are it's hit peak and maybe in fact it'll pull back. Remember, ULIP margins are in fact relatively lower than the other products. So because of that, in fact, maybe bottoming out of VNB margins is something that the street is looking forward to. And finally, if you look at the valuations, if you look at the reverse, DCF, it implies that the street is now factoring in single-digit growth on the VNB. But maybe, in fact, it can grow in mid-teens or maybe high teens as well. If that's the case, then it has some valuation comfort. And even if you look at it on a price-to-EV basis, well, then, in fact, as well, it's not out of whack. It's more or less in line with the past averages, and some of them are, in fact, trading at a bit of a discount as well. So the short point is, insurers, life insurance, they came back, and the bulls, they got insured, at least in the recent past. But Rahul, since we've already spoken about insurance companies, I wanted your take on the defense space. You all had put out this elaborate note, with regard to defense companies, and they ran away. But now you'll have turned a little bit cautious on some of them. Tell us more.
So actually, Nigel, we initiated on the sector 4 months back.
Yeah.
And we took a very, very long time to initiate on it because the stocks had anyway gone up like 5 to 10x. And we were wondering what to do with it. We took a risk. We came out with buy reports, and I think the upsides on most of the stocks were only 15-20%. But even after going up 5 to 10x, I think most of those stocks have more than doubled from the initiation. And for the kind of return ratios that they have, I don't think any defense company in India has more than a 20-25% return on equity or capital employed or return on invested capital. The order books are strong, but the working capital is entirely not in your control because at the end of the day, your biggest customer is the government of India. So you could land up making a product and it just lies there in the warehouse, and your earnings can be very cyclical and volatile. Now, superimpose that on the valuations, which were trading anywhere between 40 times for some to as high as, say, 90 times for, say, an odd Paras defense in our coverage. We were just not able to make sense of it. I mean, it may not be the right way to look at 5-year, average multiples or even 10-year because the sector has sort of come into light only over the last 3 years. But even then, on a 3-year basis as well, 2 standard deviation above mean for those kind of return ratios, I'm not sure. Because, this is very similar to IT. Order books may not necessarily translate to revenue. It may look all right on paper that I have a 30, 40, 50,000 crore order book or even a 1 lakh crore order book. But that does not guarantee me. Let me just give you a parallel example. We were discussing NVIDIA a little while back. Dixon Technologies, since the time it listed till now, has moved in a 40 to 50 PE band. It has never fallen below 40, it's never gone above 50 because he's compounded his EPS by 30 to 50% every year since listing. That kind of certainty I don't think we had in defense. So given where return ratios are, growth expectations, it was just, and the point we made earlier, HDFC Mutual Fund, Defense Fund itself has not declared 45% of the amount that they've raised. So when one of the largest funds in the country is giving you that signal, I think it's something that you should take cognizance of. And I think, kudos to, Mazgaon was what? It listed at what, 140, 150, I think? Yeah. And it's what, at 5,500 now? Really? What kind, if you want to buy a stock at 50 times, at our brokerage, we say you need to have at least a 15% upside. So what's my exit multiple? You want me to give it a Nestle type of multiple, which operates at 100% ROE, ROC with those kind of cash on books? We were not comfortable. We may be wrong, and I'm happy to go wrong. But sometimes you just need to apply a little bit of logic. If liquidity takes the stocks higher, so be it.
Okay, well, one final question, Rahul. This time there was a bit of a comeback in the IT names this week. TCS, Infosys hit fresh highs. The numbers were nothing great to write home about for the sector overall. But a lot of IT companies have told us that perhaps the worst is over, right? So whether it's Emphasis, a couple of others as well, saying that now discretionary spending is coming back, and you're also seeing BFSI, the BFS and BFSI segment doing well. Would you buy into any of these names?
So I must confess we've had a change in analyst, and obviously when different people come in, their views also change. But I think what's helped is the banking results, since you brought up
Yeah.
BFSI, have been good in the US. There has been no concern there. The US GDP growth came in just shy of 3%, so the US is on a good footing. And Europe's also not gone into any kind of mess that people were expecting. So I think we're fairly comfortable to see mid to high single-digit growth. I think valuations were trading in line with 3- and 5-year averages, which is why you saw the movement on TCS and Infy. But I don't think, Sonia, you can take an aggregate call. You also have a Wipro and a Tech Mahindra that also happened to the market. You also had a Zensar that happened to the market.
for that matter.
Exactly. So I don't think it's
So it's been a
structural,
bit of a
it's
mixed bag.
But I think if you are to be in IT, I think probably Infosys and TCS would probably be, and maybe as a third pick, I would say an HCL Technologies. I think that's probably where it is. I don't think valuations are out of whack there.
Okay, well, on that note, thanks a lot, Rahul, for joining us. We have to wind up with this edition of Editors Roundtable. Thanks a lot for watching, but keep it with CNBC TV 18 for all the news in action.